It's simple to leave your money in a checking account with a high yield, but you should try investing it to get a better return and eventually start earning passive income. Investment income can greatly increase your annual income, regardless of whether you use bank accounts, stocks and bonds, or other investment options. If you have a poor risk tolerance, use these 8 suggestions to help you start investing wisely and get over your investment phobia. Before starting, don't forget to like and subscribe to our channel for more future updates, so let's start. Number 8. Establish a plan. Once you've decided to invest your money, you must create a strategy, taking into account the following questions. What is my investment cap? Can I afford to lose anything? What do my investments hope to accomplish? How long will it take me to invest to achieve that goal? Do I understand all the terms and meanings used in the investment industry? Before making an investment, all of these issues must be resolved for a safer investment. Number 7. Understanding risk. Recognize your level of risk tolerance and how it would make you feel to lose all or a portion of your investment. First-time investors frequently make the error of overestimating their level of loss tolerance, which causes them to panic and sell when the value of risky investments starts to decrease. By carefully weighing risk and reward, you can ensure that your investments are in line with your risk tolerance. Keep in mind that there is risk involved in anything you do, including storing cash, because inflation can progressively reduce its purchasing value. Number 6. Be tax efficient from the start. You'll probably start out investing with a modest amount, and you might not give tax efficiency any thought. Keep in mind that investing is a long-term plan, thus you should think about the future potential value of your investments. If you start investing now for your retirement, you might have amassed a sizable pot by the time you are ready to retire. You can wind up paying a significant amount of tax if you haven't invested in a tax-efficient environment, such as a pension. When you open an account, be sure you are aware of this. Number 5. Diversify. A diversified portfolio of various investment funds might assist stabilize your account during an economic cycle as different markets rise and fall. Investing solely in certain markets, industries, or businesses can expose you to unforeseen problems that may arise in that area. To minimize potential losses and maximize long-term profits, it is beneficial to invest across a variety of asset classes, locations, and industries. Number 4. Don't chase tips. Punditry on shares or funds that are on the verge of becoming the best thing is all over the internet and in the media. Though these tips occasionally provide useful information, it's important to avoid continuously changing your portfolio in an effort to take advantage of them. Instead, choose appropriate investments to include in your portfolio. Number 3. Invest, don't speculate. Warren Buffett, one of history's most famous investors, once said, "It's much preferable to acquire a fabulous firm at a fair price than a fair company at a wonderful price." Even while penny stocks with their alleged high return potential through cancer treatments or prospective oil field can be highly alluring, you need to take the company's long-term future value into account, simply because they may be less properly regulated than the larger, international organizations. Very tiny companies can be risky. You wouldn't wager on a pony in a horse race if you believed that increasing your level of risk would ensure you more money. Number 2. Invest regularly. Sometimes it is preferable to make smaller, more frequent investments than larger ones. Research on investments has revealed that even financial experts believe that regular investing is frequently preferable to trying to time the market by making a single, large investment. Pound cost averaging, which seeks to balance out market highs and lows by making regular investments, may also be beneficial in volatile times. You can benefit from compounding by beginning to invest early and consistently. Number 1. Stick to your plan. When you first begin investing, you'll discover that it's incredibly challenging to tune out the chit-chat about market movements, commodities, share advice, inflation, interest rates, dividends, gold prices, and oil prices. It never ends and is essentially continual due to globalized marketplaces. A true investor should always have as their primary emphasis the long-term trends and macroeconomic elements that first created their plan. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.